Hello everyone, welcome back to Upside Down Data. Today I want to introduce a new risk indicator we just launched for Theta Network and its native token Theta. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you're returning to the channel, you're quite familiar with our risk indicators and these types of graphs, but in brief what I'm showing you here is the price history of Theta over time with the price in logarithmic form. Each dot is a day, and each day is color-coded based on the output of our risk indicator, the upside downside potential indicator, or UDPI. Scores of 5 mean high risk, that's when the upside potential is quite low, downside potential is quite high, and -5 is low risk, that's when the upside potential is quite high, downside potential is quite low. And what you can see is that over the lifespan of Theta, the UDPI does a pretty great job of identifying these high risk points, these kind of tops, as well as these low risk points as well. And you can see that more recently, Theta has been on a re-entering this kind of green zone. You know, its price has actually slipped back to where it was in the summer, and risk has fallen accordingly. It's back down in the green zone like it was back in the summer. Now, it's important to note that we're looking at the long-term UDPI here. So one of the useful features of our indicator is that we can specify different different models to care about different time frames or different types of risk. So what this model is caring about is longer-term risk. It's really concerned about moves in the market that play out over months, these kind of big sweeping moves and the risk along those big moves. It cares less about really kind of short-term small changes in volatility. You know, with crypto assets, you always have volatility throughout them. The long-term risk indicator is less concerned about this kind of intraday or even intra-week volatility. It really cares about volatility that plays out over a longer span of time, kind of these market cycle types of moves. And so essentially what this means where we are right now and getting back into the green zone is that the long-term perspective of the UDPI is that Theta has more upside potential than downside potential. That seems plausible in kind of the coming months, kind of the next coming moves. It thinks that it has more upside than downside potential in that more longer-term vision. But we can contrast this with a shorter term focused UDPI. That's what I'm showing you here. And this version of the UDPI cares more about moves that transpire over days to weeks. So it really cares about shorter term volatility. And you'll see that it does react more extremely to some of this volatility that we're seeing, you know, spiking up to some of these higher risk levels in this move here, for example, or spiking up to red before bleeding back all the way down into the more neutral territory before going on this next parabolic run. And so this is just basically telling you a different piece of information. And what's interesting to note here is that we're actually re-entering kind of this more neutral zone, which just means that in the short term, the model is becoming a little bit more undecided about where Theta might be heading next, whereas the long-term UDPI thinks that there's more upside versus downside potential in the more long term. And I think we can see these contrasts a little more clearly if we just look at the raw output of these different models. So this is the long-term UDPI. This is the raw output from that, so -5 to 5, just plotting that out over time. This is the short-term UDPI I was showing you. And we also have a medium-term UDPI we like to watch that really focuses on moves that pan out over weeks. So this is going to tell you about risk in kind of moves within the broader moves that the long-term UDPI cares about. But it's not going to be as worried about super short movements as the short-term UDPI. So kind of moves that play out over weeks, kind of medium-term upside versus downside potential. That's what this cares about. But again, if we just compare these two, you can see that the short-term UDPI tends to be a little bit more volatile, right? It's tracking those intraday movements a lot more closely. It's much more worried about that short-term risk than the long-term UDPI, which cares a lot more just about these bigger, broader moves that play out over a span of months, kind of these market cycle moves for the asset. And so going back to what we're talking about with where the UDPI stands today, it's actually a little bit lower in the long-term UDPI than it was back in the summer, which is interesting, I think. And even the short-term UDPI had actually fallen further than it had back in the summer, which is also interesting. So even though the price of Theta is at about the same place, if not a little bit higher than it was in the summer, it seems like the UDPI is actually evaluating it as being a bit or at least having been a bit lower risk than it was in the summer. And so I think the long-term one, talking more about kind of these broader moves, actually has now gotten to a lower point than it had been back in the summer, which might be seen as kind of a bullish divergence in a sense. If the price is the same but risk is lower, maybe that suggests that, theta at these prices is even a better potential risk-reward ratio than it was back in the summer, according to the model's perspective. So just something interesting to note here. Not financial advice, obviously. You should make your own decisions about how to use this information, but just something that the model seems to be suggesting, which I think is interesting. And then to wrap this up, I do want to talk a little bit more about kind of the precise levels that we're at right now, the precise numbers, and just talk about what these might suggest. So for the long-term UDPI, we're at negative 2.7, medium-term negative 1.91, and short-term negative 0.46. So as I was mentioning before, what this is basically suggesting for the UDPI's perspective is that in the long term, it thinks that theta has notably more upside potential that's realistic than downside potential. So certainly it could correct, it could fall further from its current levels. There is still remaining downside potential that's realistic from the model's point of view. But there's certainly substantially more upside potential that the model thinks is realistic. And so certainly if one thinks that theta has a lot of strong fundamentals going for it, this just might be another thing that goes in the corner that, those fundamentals might end up playing out. There might be more upside potential to be realized. Now, again, not financial advice. You should make your own decisions and do your own research on theta, and if you think that it's a good project, just what this particular model is thinking. And then with the medium term, it's saying something that's similar to the long term, but a little bit higher risk here. So it's still saying that in the medium term, it thinks there's more upside than downside potential, but it's not ruling out the possibility of downside in the more medium term. And then I think we can see this even clearer with the short term, where it's kind of returning to more undecided territory, where it thinks that theta could see upside potential being realized in the short term, but there's a slightly less but almost equal amount of downside potential it thinks is realistic in the short term. So it thinks that theta in the short term could go either way, but then in the long term, the UDPI thinks that there's more upside than downside that is realistic. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with UDPI, we're all going to make it.